Good evening and welcome to tonight's live webinar where we look at the ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Up on screen's a interesting graph which looks at the performance of the global share market during major recession periods over the last 50 years. The line on the left here, which is the red line, shows you the current market, the current sell-off in the market. And I'll put this into context. So you've got the number of months along the bottom here. So this is the length of the downturn in the stock market during these recessionary periods, and in percentage terms. So this represents about a 30% sell-off down here, which was the 07-09 recession, represents about a 56% sell-off. So in simple terms, about half of the recessions across the last 50 years have extended greater than 30% in their sell-off. So it's roughly around the same in percentage terms. So roughly half of them have been close to a 30% sell-off, and the other 50% have been something more than that and nearing on average 50%. But what is consistent is the duration of them. The surprise with the current move has been how quickly the sell-off has occurred, whereas if you look back at, say, the 1990 recession, it was sort of one of the shorter period recessions of about eight months. So as investors, what we're needing to work out at the moment is the market going to enjoy a sharp snapback and a return to economic strength like Trump suggests, or are we actually going to see a continuation of a down move in the market, which plays out as the economy struggles in a recessionary type environment? And that's really the focus of tonight's recording, is to try to start thinking about these issues and how they impact portfolio allocations at the moment. Jamie Dimon, a CEO from JP Morgan, he says that he doesn't expect the worst case scenario, but he is saying that it's possible that this plays out as a bad recession. It's pretty hard to get a good recession. I think any recession seems like bad news, but it's interesting that he takes a fairly dim look and expresses his concerns around the outlook for the US economy. And I don't think the US share market is really sharing these views at present. And again, that's something that we'll focus on as we go through tonight. Charlie Munger, who's the vice chairman of Berkshire Hathaway, partners with Warren Buffett, in a comment he made in the Wall Street Journal, he's highlighted that from Berkshire's perspective, it's a bad typhoon and they're happy just to come out the other side of it. And you can have a read in more detail with what's up on screen there. Warren's concern is just ensuring that there's liquidity. They're able to seize opportunities as they occur, but his positioning is one of a fairly conservative one. So how does this flow through to market allocations? The Nasdaq up on screen here has been a leading indicator of global equity markets for the last 10 years. The bull market started with a technology boom in areas of cloud computing and services around the technology sector, and the Nasdaq's enjoyed stronger gains throughout that 10-year period. And for the most part, the index has been under algorithm buy conditions over that 10-year period. Over the last 12 to 18 months, we've seen volatility start to pick up, and we saw the first of sort of the sell signals begin to occur late 18, early 2019. switched back to algorithm buy conditions here in roughly the mid part of last year, and we had a strong rally throughout the year for another buy signal around this point here, and then now the market's under sell signals. So this is the first warning for us, is that when the leading indicator of the market has had such a significant sell-off, created a lower low, the bounce back's been sharp, and we're looking out at how the earnings are going to be as they start to come through for the March quarter. We had the US banks report earnings last week, and there were concerns expressed as to what those impact of a recession or the increased unemployment, home loans, commercial real estate, a whole variety of issues there that impact the bank. The market's getting comfort because the banks are well capitalised, but it doesn't necessarily negate the damage that's yet to play out in the stock market. The March quarter may not be the worst earnings results, and maybe June the numbers are even worse still. And is that going to be a tough period for the market to get through? I think that's the thing that investors need to think about. So as we go through tonight's stocks, we'll be looking at it from that point of view. Bringing into screen the Nasdaq chart, which we're just looking at there. So again, just looking at it, within the charting module rather than as a PowerPoint presentation there. So we had the large sell-off down to 6,500 points, approximately 6.6 in the Nasdaq. We've had a bounce back that's been slightly more than 50%. Now what we need to do is watch how the market behaves at these levels, watch the shorter term momentum indicator, and just see whether we start to see price struggling below this this resistance level or the potential resistance level. I suspect we'll be, with Coca-Cola reporting their earnings tonight and roughly 20% of the S&P 500 reporting over the next week, we'll really start to get a sense for how the market is going to digest the first round of these US earnings results. So it could be a catalyst for the price to start to struggle. Then in the following week, as we start to see some of the bigger technology companies report, that'll really sort of flow through to how the Nasdaq behaves. So I think we're sort of at that early stage of the earnings season for March, which will start to give us a bit of a sense for as to how the market starts repricing stocks. But I suspect that you will see some selling pressure as we go through this earnings season. And again, the concern being that the June results may be worse still. If we think back to that recessionary PowerPoint and the length of those cycles, we know that often the stock market can start to recover before the economic data does. But when you look at those over the last 50 years, most recessions have lasted somewhere between 8 months to as much as 36 months, but certainly between 8 months and 24 months. So the concern here would just be that the market runs into resistance here and we start to see some selling pressure, and that's what we want to keep an eye on. Moving straight into the table for the top 100, and I'm going to start by getting the percentage gainers to the top. We're going to organize these in buy order, and I'll move through the buy signals quite quickly and try to finish on a couple of sell signals or short signals for us to start having to think about. But the logic here with focusing on these buy signals, these are the stocks that we've been covering on the blog, and they're names that you're likely holding in your portfolio. So I just want to share with you some analysis on that and thoughts as to which ones are likely to experience sort of more volatility in a tougher economic environment. So Ansell's bounced back very well. So at around $30, we think this is back to full value. So we see it really moving sideways at the moment. Sonic Healthcare, we see this as lower volatility. So this is a name that you could continue to hold in portfolios and sell covered calls over. A combination of the dividend and the call option, you're generating between 8 to 10% cash flow per annum. And in some ways, a portfolio that has a set of stocks in it at the moment that offer low volatility and you're driving your returns through those covered calls, I think that starts to give you the upside growth in the portfolio through 10% return through the dividend and the call option income, as well as still allowing for some obvious capital growth, but you're able to concentrate your portfolio on lower volatility names. So Sonic Healthcare fits that group for us. The iron ore stocks, Fortescue, BHP, and Rio have held up well as iron ore's maintained around that $85 a tonne. But it's hard to see how these stocks push higher over the coming months. So I think taking some profit and trimming some of your position sizing in those iron ore stocks makes sense to me. Afterpay, we're not doing there at present. Horizon, so just maybe make a note of this, have a look at it, sub 425. I've posted on the blog about that as a entry level, but so sub 425, take a look at that. It does have a slight defensive characteristic, AZJ, or maybe slightly less exposed to, say, the bank, opposed to the banks or financial services in a soft market. Macquarie, we're starting to get a bit cautious here on Macquarie, and again we'd be looking to trim the position there in Macquarie. Bendigo and Adelaide, not doing there at the moment. Amcor, so global packaging business, back at 1360. We see this as full value and selling fairly tight covered calls to drive the income out of Amcor. ResMed within the healthcare space, I commented on this in a recent recording that a number of analysts have downgraded their price targets on ResMed to sit more between sort of that $20 and $22 price range. We last had sort of the algorithm buy signal there at around $20. The stock's now trading $25. Altium, at these levels, I wouldn't be chasing Altium. I think given their technology exposure and our concerns with where we see the Nasdaq index at the moment, so not chasing Altium. Woolworths, so this is an example of a defensive stock that you could add to your portfolios and sell tight covered calls over and generate 8 to 10% cash flow over the next 12 months from, and we see the downside risks as fairly low there for Woolworths. Downer EDI, not there at the moment, so that's in infrastructure and mining services, so we're just avoiding that at the moment. Aristocrat Leisure, we think this bounce back is largely sort of captured, sort of a re-rating there in Aristocrat, and we're not chasing that one to the upside. Xero was one that I posted on the blog down here, and we're about buying it in the $60 price range, back up at $78, $80 is full value for the moment, so we think the short-term trade there's been captured. So in all these technology names, so if you've been following the recent recordings, it was Xero, Seek, Car Sales, REA Group, leading technology stocks within the ASX 100, and they were a sort of favoured theme on this bounce back in the market. But again, we're of the view that the bulk of that upside's been captured, and we really want to be on the sideline with these names and just see whether we get a more meaningful pullback if we are to see that Nasdaq roll over. So Transurban is toll roads. We think the company will cut the dividend. So when economic times were good and the company was paying out 52 to 56 cents per annum in dividends, we think that's likely to come back to something more in the order of 45 to 48. So at around $12 to $13, we think this is full value, and that's in an environment where the world's slowly returning to normal. If unemployment levels stay higher than what we went into this period then it's natural that overall volumes on the toll roads are going to be a little bit lower. So interest rates have moved lower as well, which is a slight offset to some of those volume considerations. But with Transurban back at around $13, we think that's full value. But owning it and selling covered calls is something that seems like a reasonable risk-reward strategy. If you share the view that in the coming weeks and months, some level of normality is going to return, and that's obviously still a risk to the economy, as these second and third waves of COVID-19 infections and flare-ups like we're starting to see a little bit in Southeast Asia and in particular in Singapore, which still need to be monitored. So, but that aside, I think Transurban, from a risk-reward standpoint, is worth considering. Coles, like Woolworths, are comfortable with this. So consumer staples, owning these and selling covered calls and driving the extra income. BHP, for the moment, we just want to be a little bit cautious on BHP Rio Fortescue as we wait to see how this US earnings season plays out. Coca-Cola came out with disappointing volume numbers. So it'll be interesting to see Coca-Cola in the US report tonight. And we'll start to see the impact of the main distribution being through shopping centres rather than events. And from what we saw today in Coca-Cola, Amatel's result, it seems to be a material impact on the business, so meaning that sort of traditional shopping centre channel is not enough to replace what was happening out there during a normal economic environment. Medibank Private, so health insurance, just not doing anything there at the moment. Northern Star, so this is one to make a note of, and you can certainly have a think about this. I think gold, both Northern Star and Newcrest, owning it at these levels, and again, either selling covered calls out of 10% above the market, collecting the extra income, or you may want to leave these names uncapped and try to capture a bit more capital gain in them. But this sell-off in gold's a buying opportunity if we are to see the equity markets come under pressure as we move through US reporting. Magellan Financial Group, again, a little like Macquarie, we think sort of the bounce back in this name has probably been captured, and you just want to either take profit, trim the position, or just step aside. REA Group, so this is part of that technology basket I mentioned. So our view here is that these names were the fastest growing businesses going into this sell-off, and we want to own them coming out the other side. But the bounce from 65 up to 85, I would let it settle. We're looking for a slight pullback in this, and we'll keep an eye on really how that Nasdaq trades under that potential resistance. CBA, so avoiding CBA for the moment, as we are with Westpac. Telstra, so global telecommunications, earnings down anywhere from 10 to 20%. So Telstra is not going to get through this unscathed. Obviously more defensive than the banking stocks, so there is a price point near $3 where you may want to own Telstra. NIB Holdings, so health insurance, avoiding that at the moment. National Australia Bank, again avoiding the bank. So we saw the NABs come out today and announce $1.1 billion of provisions, which mainly relate to prior matters, not COVID or recessionary type issues that they're allowing for. We won't see the full detail of that until next month during NAB's earnings release, and that'll really give us a sense for how big the provisionings are that the major banks are going to have to make for recessionary related losses. Ramsay Health Care, so this was one that we're bullish on, flagged it on the blog there at around this $50 level. It's bounced back to 65. I don't see any earnings growth in Ramsay this year as elective surgery is allowed again. We'd expect the earnings to recover, but given the damage that's done, we don't see earnings growth for the business. So I think back here at around just over a 2% dividend yield, the stock's back at full value. JB Hi-Fi, not doing there at the moment. APA Group, so this is one we're bullish on at lower levels, back at full value, and we can't do covered calls over that, so I wouldn't be looking at too much there at the moment. Computershare, just let this settle as we see how the Nasdaq trades around that potential resistance level, and we'll revisit Computershare on the blog if there's an opportunity to buy that at lower levels. Orica, not there at the moment. So you can see the group of stocks that we're looking at is getting quite narrow. There's only a handful of names out of these top 100 stocks that we're willing to buy at the moment. The ASX, so obviously bullish on this at much lower levels. It's back at full value, so we've either taken profit in this or sold covered calls. I don't see ASX trading higher from where it is at the moment. TPG Telecom, we've really trimmed this so we don't hold this in portfolios anymore. Rio at around this $80-$90 level. I'm just concerned that iron ore is going to struggle a little as we go through US earnings. Sydney Airports, again avoiding this at the moment. So we've exited Sydney Airports after this bounce back. Oil Search, so not doing there. Wesfarmers again, I think allowing for this bounce back. I think you just have to take profit or trim that position for the moment and see how this US market plays out. Carsales.com is part of that technology basket, so we're probably not willing to take a look at this again until it's back down at around $12. We'll continue to update you on the blog and on future recordings on that. Cleanaway Waste Management, I think this is lower risk. I'll flag this on the blog that sub $1.80 it's back in the buy zone. I've explained in prior recordings the reasons for being attracted to this business, but somewhere between this sort of say 165 to 175, to me this is getting back in an area that you can start to think about adding this one into the portfolio. So obviously waste management company, so as some level of economic activity returns, Cleanaway will return back to more normal trading conditions. QBE Insurance, again avoiding that. Cube Holdings, for the moment we're just avoiding that. Qantas, avoiding. Beach Energy, we're avoiding that. Insurance Australia, we're not doing anything there. Within the energy space, Santos and Origin, or the Triple O oil ETF, I think oil was down today, down at WTI trading around $17. One would assume we're getting pretty close to sort of the lows within where oil trades, and maybe if we get some level of economic activity returning, that'll start to be a catalyst for oil to improve a little. But even if it is a rally from sort of 17 back up to $25 in percentage terms, that's quite good. Santos Origin will be a beneficiary of that, so just keep an eye on energy prices over the course of the next week, because it may be that energy finds a support before, even whilst US equities are moving lower. Newcrest, so this one here, I've flagged that as a buy range that you want to look at. So Newcrest and Northern Star, to me, in this environment, provide a buying opportunity. So I've just flagged the range there, so from 25.50 to 27.50 in Newcrest. So again, own it. A more defensive strategy is to sell covered calls. You're getting good premium up at sort of $30 or $31, so you're still capturing good capital gain. Getting some extra cash flow for it, and you only have to go out a month at the moment to even collect reasonable premium for these, and you're still allowing for good capital growth, but the gold price is likely to firm in the weeks ahead. Goodman Group, so within the property space, this is one of the only property stocks we're willing to look at. They obviously focus on more online logistics centres, but again, with the stock rallying 30% off the recent lows back at around this $13-14, we think it's close to full value, and you can't do call options over Goodman, unfortunately. James Hardie, not there at the moment. We think both James Hardie and Boral have really bounced back to a level that they start to run into resistance. CSL, we just note here again, like ResMed, we've seen a number of analysts slightly downgrade their earnings outlook for CSL, and we don't see that too often. It's one of the best performing stocks in the Australian market. From an algorithm standpoint, it shifted from sell conditions into buy conditions there back in 2015, and has continued to perform well with subsequent buy signals along the way. But I'd expect to see CSL come into a period of consolidation. They have partnered with a company as part of their search for a vaccine for COVID-19, so that could be something that causes it to break out on the upside. But based on earnings, on what we know, we think the stock sort of consolidates and moves sideways, but it may end up looking back as a period that turned out to be a good opportunity to buy CSL. So we'll continue to watch that on any pullback that we see. Oz Minerals, so we're obviously bullish on Oz Minerals as one that we've flagged on the blog. As a basis for buying this was copper finding support, and also that Oz Minerals was expanding their copper mine in South Australia, and we saw the latest production results that came out over the last week, or early last week, which showed the increase in copper production, which will flow through to higher earnings, and that was really the cause for the stock rallying from that $7 support back to $9. But again, for the moment, we think that's full value, but great business and happy to buy it on any pullback in the next algorithm buy signal. So Mirvac, not there at present. Cochlear, we've spoken in detail about that, so we're happy to own Cochlear. They've shored up their balance sheet with their capital raising at $140 a share, so buying that on a pullback. So it may be worth just making a note on your piece of paper there or your keyboard with Cochlear. Dexus, not doing there at the moment. Flight Centre, not doing anything there. Soul Pattinson, so a couple of these I'll skip through. We're getting sort of down into the back end of back part of these signals. GPT, not doing there. Origin, again, look to buy this on the dip, so we'll revisit that on the blog. Atlas, AMP, not doing there. Brambles, so Brambles came out and with an earnings guidance of around 6%, which is still, I think, pretty good in this market. We've had a view on the prior recordings that at around $12 it was full value, and I mentioned that sort of that's a selling point, and it's really not until it's sub 10.50 that would be a buyer again. So just keep an eye on this. If we do see weakness in the US this week, there may be an opportunity to buy into Brambles at sub 10.50. Lumina, not there at the moment, or in BlueScope. Lendlease, again avoiding Lendlease. So these names that I'm skipping past or saying we're avoiding, they're ones that you really want to think about trimming your exposure to and trying to free up capital to concentrate on those lower volatility names for the moment. Celtex, not there. Now we get into sell signals. So I generally haven't been covering research on these sell signals, but given our outlook on the market or the potential outlook with the recessionary pressures and the sell signal in the Nasdaq, I just wanted to move through these tonight and provide some comments on this. So what we did at the beginning of this segment was we went into the watch list, organized it by percentage gains, and got the buys to the top. As we've toggled through these stocks, we're going past the stocks that are under buy conditions, and we're now moving into the stocks that are under sell conditions. And obviously, as we keep going through those, we'll see ones that had a greater percentage sell-off today. If we go back to the watch list there, and I'll just move through these. So Evolution Mining, so we had a sell signal there in Evolution. Our preference is Newcrest and North Star. Unibail, not doing anything there. The short signals here have performed very well, so just as I'm toggling through these, take note of the algorithm short signals at the top of the screen, and then just how the share price has behaved since those signals. So WiseTech Global, it's fallen from 30 down to 15, but still on the short side of that. Scentre Group, so concerned there with Scentre Group. So Tabcorp, so still on the short side of that. Whitehaven Coal continues to make lower lows and lower highs, so short side of that. Domino Pizzas, Spark Infrastructure, Treasury Wines, still on the short side of that. AusNet Services has just come under short signal at the moment here at 180. Link Administration, so on the short side there. A2 Milk, so it's one that's broken out and gone the other way, so it's pushed out above the algorithm short signal up there at around $18, and that's as A2 Milk's expanded into the US, the market. But it's worth just noting A2 Milk, there's no dividend, and you're probably looking for 2 or 3 years more of earnings growth before you start to see a substantial dividend stream come through from that. VCX not doing there at present. Crown Resorts, so still undersell. So as we start to get into these next couple of stocks, I'll just pause a little bit more and just talk about if you're looking at the market shorter term and you're wanting to capture some of these short positions in the market. So the type of thing you're looking at is a resistance line on the top of this bounce back in the market, looking at the short-term momentum indicators and just sitting on the short side of the stock as long as those momentum indicators are trending down and the stock stays underneath that resistance level that we've put in there. And that's all predicated on the fact that a number of these companies in the market are going to struggle under that same type of technical pattern that we're seeing in the Nasdaq. So Bank of Queensland, same thing there, you got resistance at 530, the short-term indicators turning down, so just track those over the coming days. ANZ, similar pattern. So both, I've been posting on the blog about ANZ and NAB on the short side, so the setup here in these doesn't look good at all. So I'm concerned that you've got another substantial leg lower in ANZ and NAB. And the index. So this is the top 100 index. You'd probably normally look at the XJO, which is the top 200, but this is the pattern here that we're concerned about, is that does the Nasdaq run into resistance? Do we get further selling under this bounce back? And how does the US earnings play out as we start to push through the next three weeks? And in particular as we get into the back half of those earnings and we start to see the big US technology stocks, and to see whether the earnings growth supports the high multiple that they're on. Boral, so this was one that we were bullish on, but at around this sort of $273 starts to look full value. Suncorp, I think just worth, so make a note about ANZ, NAB, Suncorp on the short side. I think there's pressures there building. CIMIC not doing there at the moment. So CIMIC was a stock we were looking at. That's now taken off the list. So again, we're really sort of trimming down the number of shares that we've got exposure to. South32, cautious there with overhead resistance. Iluka, resistance there at around $8, so a little cautious there. AGL Energy, resistance at around 18, so it's trading below that. Don't see too much downside risk for AGL though. Charter Hall, not doing really there at present. Incitec Pivot, you can see the resistance there at around 225. Aurora, resistance around 270. Woodside Petroleum, so resistance there at 2250. Reliance, resistance there at just under $3. Stocklands, just above $3. You got overhead resistance. Worley, so this is a stock that I'd be putting on your list as well. So on the short side there, as long as those short-term indicators continue to trend lower, Worley sub that sort of $7-8 level as overhead resistance. But it's hard to sort of go past ANZ and NAB, Suncorp, Worley's. I think they're all shorts that you want to start having to think about, and as I've posted on the blog, the inverse ETFs. So the way an inverse ETF works is, in this case, the BBUS is based on the US S&P 500, and it's an inverse product. So if the US equity market goes down, this goes up in value. It's got 2 times the leverage, so if the market goes down 1%, this will go up by 2%. But if the Nasdaq runs into resistance, where we've flagged on that earlier chart, so too will the S&P 500, and it's just a way to think about if you're wanting to hedge a portfolio. You can do it through the ETF market. You could also use index futures, but BBUS is over the S&P 500. If you want to do something over the Aussie market, the BBOS, so it's rallied from $11 up to $12 today, and if we saw the XJO, so the reference there for BBOS is obviously how does the XJO trade. So there's that same pattern. Are we looking at resistance up at around 5600 and the market struggling below that? Keep an eye on these short-term momentum indicators. And just to finish tonight, we'll just go through these blog posts and just revisit what's been posted on the blog. Okay, so here's where you just want to make sure you've made a note of these. So Sonic Healthcare, buy right over this defensive income play. Horizon, sub 425 is a buying opportunity. I'll revisit that on the blog. Amcor back at full value, so either take profit or sell covered calls, move sideways or slightly lower from where it is there. Woolworths, so we're happy buying this, selling covered calls, driving income out of that. Xero really capturing the profit, so that trade's finished for the moment. Coles, take a look at this, back down at sub $16, around that $16 to $15 range there, buying that and selling covered calls. The gold names that we like, Northern Star, so think about adding that into your portfolio. REA Group, these tech names you want to have a look at, but not now. The rallies largely done for the moment, and we're just standing on the sideline watching how this Nasdaq behaves, and then we'll buy into some of these tech names on another pullback. So I'll update you on the next recording or on the blog more about that. NAB, cautious on NAB with overhead resistance at around 1750, so you want to be looking at that on the short side. Ramsay Healthcare's back to full price, so take profit on that, move sideways and you can't sell covered calls. Sydney Airports, think about taking the profit here at the moment. Obviously, if we do get 6 months down the track and life's return to normal, you're going to see Sydney Airports at higher prices, but a little like Transurban, we're probably unlikely to see economic activity back at the levels it was prior to this in any short period of time. So full value for Sydney in a normalised market might be more like 750. So there is some upside in it, but risks remain around that, and we're happy to buy it on a more substantial pullback. Car sales, so we promoted this at lower levels here at 14, take profit, and as with that technology basket, we'll take a look if we get a further pullback. Cleanaway, I think this is a name that you should be watching closely. Sub $1.80 is a buying opportunity, so it's a defensive business that should hold up well even in a soft economic environment. Newcrest, buy on the dip here. I think that's a good opportunity for portfolios. Oz Minerals, we were bullish this, it's captured most of the rally, and let's take a look at that if we see a more substantial pullback below $8. Cochlear, you can be comfortable that the balance sheet's in good shape here. At maybe 200, it's getting a little expensive, especially with the backdrop of the market that we're concerned about. So I'll revisit this on the blog, but maybe back down at around that 160, 170 level becomes the entry level for Cochlear. InvoCare, we have it. I made a point of just posting on the blog that the company had raised capital at around $10.40 a share from memory to shore up their balance sheet. We don't hold this in portfolios, but it's one that I'll revisit on the blog if we start to look to add that in. Brambles, I really warned against this up at $12. It's a good story. There is earnings growth, but slowing economic environment, we're not that certain that the earnings growth can be maintained, so we're only buyers of it on a more discounted valuation. So again, I'll revisit that on the blog when we see that. Evolution, so it's a sell signal, take profit. Treasury Wines, not doing there at the moment, that was a short-term trade. And then the XJO index. Suncorp resistance, I spoke about that under the short trade, so if you're looking for short trades, make a note of that. CIMIC, we're not doing there at the moment, we're actually holding off on CIMIC. And then back to Sonic Healthcare. So the message to leave you with tonight is the US stocks here and this Nasdaq index. So what we're watching for is, are we getting into a period where the market has bounced back too much too soon, and earnings both in this March result and the June result don't support the current PE valuations. And it seems that that's quite a probable outcome. So I think there's enough reason there just to be a little bit cautious with how you're positioning your portfolio at the moment, how much cash you're keeping on the sideline, and keeping an eye on this NASDAQ and reading the blog for additional research and advice. So thank you for listening in, and I look forward to speaking again next week.